Pretty much that nobody knows what the hell's going to happen in the
Tell
future.
people, first off,
let's talk. Yeah, let's take a step back here.
Yep.
Dave and I
Commercial
went
finance.
to the Commercial Real Estate Lender Association conference and at the networking event, and the topic was the impact of rising interest rates on commercial real estate.
Let's talk real estate, commercial real estate, pretty much focused on South Florida, where I read the headlines all week, come up with some articles to go over with Ralph, and we dive down in them with some laughs, and let's see what we got. So this week, you want to start? You got it open or something like that? What's going on?
I got the one that's interesting, which it's funny because some said coming into revitalization, coming back. Lincoln Road,
Miami Beach.
Yes, sir.
South Beach.
Steve Roth Bernardo sold Lincoln Road building for $94 million, nearly 30% less than what they paid a decade ago.
I'm showing a picture right now. That's the Lincoln Road movie theater, I guess.
Yeah,
right?
At the Regal Cinema, which is anchored a retail building on Lincoln Road. Which said it before, discounted for $93.6 million. Bernardo sold the property, 1100 Lincoln Road, to an affiliate of Steve Galzini's BH Properties, which are based out of LA. The price is 29% less than $132 million Bernardo paid for the building in 2012.
So we got to say, that's probably one of the only buildings right now, just talk for South Florida, that probably has decreased over time. We're coming over this crazy increase in sales and rents and everything has been robust. And here you go, Lincoln Road retail is taking a 29% hit from $132 million back in 2012 to $93.6 million. Why?
Well, that's the next sentence. It comes on the heels of the affiliated of BH Properties buying the property mortgage in December from lender Credit Agricole Corporation, an investment bank based in Paris, the record shows. Bernardo, which had publicly traded, reported that it defaulted last April on an $82.8 million non-recourse loan on the building, according to filings with Security and Exchange Commission.
But this makes sense.
Yeah, it makes sense.
This is a movie theater. Nobody went to the movies. I just went to my first movie since COVID. Is that true? I go to another movie before that. Just saw the new Tom Cruise
Maverick.
Thing's amazing.
Yeah,
you gotta see it.
I want to see it. I'm dying to go see it. I haven't had a chance to go yet. Yeah.
It's great.
So it makes sense. You're right. Movie theater. Lincoln Road. Yeah. We all know that within the past, 5-6 years, maybe the last.
They said it was renovated in 2017. Tenants include Ben & Jerry's, Romero Brito's Gallery, very, very popular artist in Miami.
Right.
And Casper, the friendly enough, the mattress. Still, several tenants have closed after Bernardo sued them for unpaid rent 2020 during the pandemic, including Pena and Republic and Lauderey. The cases have been resolved. Court filings show.
So this is a classic case of how the pandemic. This is still kind of a residual collateral because of the pandemic.
Yeah, right? Man, that's it. That's an impact, right?
Huge impact. I mean, Banana Republic. I mean, this isn't just small mom and pop stores here. Lauderey, Regal Cinema. I mean, it's huge.
It says right here, South Florida retail market has been rebounding following the pandemic-induced slump, with Miami-Dade County's first quarter vacancy rate hitting 3.7%. That's great. That's very strong. Down from 4.5% during the same period last year, according to Collier's report. There you go. Asking rents average $40 per square foot, not Lincoln Road, and up to 11.4% from 36. They're talking about fully across South Florida. Lincoln Road, probably around there, is getting anywhere from $75 to $125 a square foot for retail. I mean, that's prime. They just built something across Alton Road right there. And then I just appraised the new, maybe I shouldn't be talking about it, but the proposed development from Shovu
right down there. And then we've had conversations with various lenders who've reached out to us to pick our brains about what's going on Lincoln Road. And
it's a mix of things going on.
Yeah. And it's interesting because if you look at, this is a good spot in Lincoln Road. This is the heart of Lincoln
spot. It's amazing.
Yeah. And to hear that.
It's the anchor, they say.
Yeah, exactly. But you would think that by now, with the movie theater starting to come back, the question I would ask on this, what's the condition of the movie theater? Because nowadays
it's always been good.
It's always been I've never been to that movie theater.
Here's the thing. If you go to new movie theaters now, like I haven't been to the one in Brickell, but I went in the one downtown, which is right by Whole Foods over there. It was amazing. I'm talking big recliner chairs, like big, like this big.
Right.
Recline, plenty of space, the swivel tops.
They're making an experience
now. The waitress is there before the movie starts. Full bar outside. You can go there with a date, sit at the full bar, and it's nice. It's not like, like there's a little bar in the corner. No, this is nice. I ordered like a Philly cheesesteak. They had chicken and bacon, avocado sandwiches. I didn't even eat popcorn.
But it's
we had a beer, a craft beer, an IPA. I had a Philly cheesesteak all before the movie started. Watched the movie. It was full. Great movie. Great experience.
Now that you mentioned that, it's funny.
Miami Beach is not that. Miami Beach, though, that movie theater does have a VIP theater, one of them.
Right.
So they do have that, not to this standard. And it would be smart for them to kind of gravitate or pivot to that. I think that's what most movie theaters are doing now.
Well, and it's funny you say that because
it's a better experience.
Correct. I've been in Miami now back 3 years. Okay. Most of you know out there, I lived in Dallas for 5. Now, my first movie experience in Dallas was in 2015. It was that exact formula. And if you go to a movie theater in Texas, at least in the Dallas Metroplex, they're all like that. Full bar, waitress service, full recliner chairs.
Amazing.
It's a formula that you want to go to the movie theaters. It's not the old days of sticky floors and, stale popcorn and $10 hot dogs. They're actually making it more of a enjoyable experience. It's like they're incorporating a night out in one spot. Before, rather than go to a restaurant and then go to the movies, they want you to do both in one location. But it's interesting because now with this transaction, I'm curious to see what they're going to do with the movie theater space, because the rest of the retail space, we know that eventually that's going to be recapitalized. Somebody's going to come in. They're going to take that. I'm not concerned about that. I'm curious to see what's going to happen with this movie theater space.
Keep this in front of your face. Yeah. It's still going to be a movie theater.
Yeah.
They're not saying that it's not going to be a movie theater.
Well,
I didn't read that.
I didn't read that either. I'm just saying.
He just sold for a loss.
This is just,
you know what I mean?
This is just my opinion. I'm sitting there going, they're probably going to come in.
If their proposed development across the street, with those rents, their proposed Class A development across the street, $100 is triple net for office with $75 retail on the bottom floor for sure. And then brand new retail across the street as well. With now they're going to do like a outdoor cinema outdoor. Like what is it called? Like a drive up.
The new concept where you go to the rooftop
like that. Yeah.
And in the nighttime lay out the blanket, get the waiter services.
So there's a lot of synergy right there. So I just think they're gonna need to revamp it, rethink it they need to renovate it like a multifamily house. I mean, that's it. But look, I lived on the beach when that movie theater didn't exist. That's been the only movie theater on the beach. And we had to go to Coconut Grove to go see movies. So and that was in the 90s that they put that in there. So yeah, it's time to, revamp, pivot, get back up to, modern stuff, what's going on, and compete with, but they can do it.
Yeah, no doubt.
All right. So I'm going back to Moish Mana. Says he's almost done assembling downtown Miami portfolio with the new purchase. Again, we've spoke about Mana in the past. Mana again said he's almost ready to move forward with construction of his downtown Miami master plan. That's what he looks like. Yada yada. And so Moish Mana is not quite done buying properties for his downtown Miami master plan. The investor and developer paid $7.3 million for a building on Flagler Street, formerly home to the Children's Place store. He announced he owns the property surrounding the site. Manor reportedly nearly finished assembling his Flagler District portfolio downtown, which now totals more than 1.3 million square feet of dilapidated buildings. No, spread across 70 buildings. Next construction would begin on a large scale. So far, his major accomplishment has been the Nikola Tesla Innovation Hub, which is expected to be completed early next year. Not sure what that is.
That's the building that we've seen. That's a shell. It's probably the only building that we've seen
That's
that
going to be
he's
the
done.
Tesla?
Yes, that's the one on South Miami Avenue.
I know what you're talking about.
Yeah, it's the only one that we've seen any activity in that corridor.
All right,
Which is
that's
at
cool.
least that was the one we first saw going.
How's that one going?
I haven't been by there, but I'm pretty sure. Hey, to be continued.
It says along the way, Mana, who also owns a massive portfolio in Miami's Wynwood neighborhood, has faced delays and starts and stops. Earlier last year, Mana announced that Silicon Valley investor and accelerator Plug and Play plan to open an office within the Flagler District project, but that is no longer happening. He began work last year, 777 International Mall building at 145 on some Flagler Street. Construction is underway on the 13th story office building that you were just talking about. Also downtown will be the Nikola Tesla Innovation Hub. I don't think it's that building that you just said. I think they're two different things. Mana has also been assembling land in Alapata, which, if you don't know, it's across I-95 to the west, a working class neighborhood west of Wynwood, also undergoing major redevelopment. He's recently paid $16 million for 10 properties along Northwest 7th Avenue between 28th and 29th Street. Okay, moving on. That was my Mana news.
It is a 155 South Miami Avenue.
What?
That is a Tesla building.
Really?
Yeah, that's the one we
That's not what this says, but
it says it here. He began work last year at 77 International Building at 145 East Flagler downtown.
But 77 International Mall is not.
Hold up. And construction underway on 13-story office building on 155 South Miami Avenue.
Right.
Also downtown, which will be the Nikola Tesla Innovation Hub. That's the building that we pointed at.
My bad. Yeah. My bad. Okay. Yep. I stand to be corrected, Mr. Ralph Pena. Sorry about that. So, where do we want to go next? For some reason, I put in here some finance. What do you think about that conference we went to today?
Actually, very, very interesting conference. Very informative.
What'd you learn?
Pretty much that nobody knows what the hell's going to happen in the future.
First off,
let's talk. Yeah, let's take a step back here.
Yep.
Dave and I went to the Commercial Real Estate Lender Association conference and at the networking event, and the topic was the impact of rising interest rates on commercial real estate. And what I found interesting is it's kind of like the way everybody's approaching it. And Dave, correct me if I'm wrong, but what I took from it was, well, we're starting to see the way lenders are adapting to the rising interest rate. They're starting to become more creative in the financing side of it. And what we're going to start seeing is probably focusing more on debt coverage ratio. You're going to
loan to value is decreased.
Yes, you're going to see a decrease in loan to value.
Means you're going to less leverage.
Less leverage, higher debt yield on the takeout, debt yield of the NOI into the loan amount.
Higher debt yield, correct.
And so we're going to start
seeing... But they are softening the debt coverage ratio.
Correct.
They said 1.25 to 1.2. They said that 5 basis points is huge in the lending world.
And we're still hot at multifamily.
Yeah, everybody.
That was really the hot topic.
Multifamily, what they said really is multifamily value add.
Value add.
Because they brought up the good point of you're buying at a 4 cap or sub 4 cap, and you're lending at a 5 cap. You're negative leverage. But that's not the way they're going to look at it. They're going to look at basically your third year or fifth year debt coverage
and takeout yield.
Takeout yield from your third, fifth year.
Correct.
And if you don't know what a debt yield is, it's NOI divided by
the loan amount. The
loan amount that's left over on your third or fifth year of your exit. And if you want to see what the NOI is at that time, then you times it by
the bottom line, if you're a borrower sponsor out there, they're focusing on the business plan. What is your business plan?
Because it's like I said when we were walking back, is that it really concentrates on the operator now.
Correct.
Because you have to be able to execute.
Yep.
Because if you're going in year one negative leverage, and the lender is really concentrating on how you're going to get to year 3, year 5, then it's really up to the operator to execute with his team and know, because we're seeing still a bottleneck of labor costs are going up.
Construction costs
have gone up.
Rents are going up, and
rents.
they're going. We've all, you and I, are on the
same
page here, because the increases that we've seen year over year in the past year, that 20-30%, and we've talked about in multiple articles. I personally think, in our observation, I personally don't, this is just my opinion, I don't think that we're going to see those astronomical increases in rent. I think it's going to stabilize more down to your typical 3 to 5%.
Well, that's definitely a question that they were stating, the lenders, in trying to get with their underwriting team or research teams, and all these different people that were on the panel do have access, because they're major, CBRE or
the Cushman,
or JLL, or whatever, they have access to commercial real estate appraisers or researchers or brokers, and they're trying to communicate and collaborate and see where the underwriting is going to be, and everyone's kind of on hold to see what's going to go at the end of the summer, 3 to 6 months.
Right. And I think from what I understood, the way they're underwriting is they may have maybe a bump up for year 1, but then going forward, it's kind of your stable, typical 3-5% bump up throughout their underwriting process, throughout the cash flow.
Yeah, I mean, that's what I'm seeing in the market too. I mean, I have email after email of sponsor telling me, oh, rents have increased this. That's, we haven't even renovated certain units because we're getting a bump on our non-renovated units. So the tenant's not moving out. They'd rather just take the bump, and the bump is, is substantial. It's 20%. Yeah. So, but that's not going to last long, and we can't model that. And so, where do we go in the future? What are we doing? And the short term is going to, I guess that's a good segue. I was going to talk about, let me just talk about this real fast. But this is, my next article says FinFarp Group joint venture rev up construction on its Thompson Hotel anchored mixed use project in South Beach. Another South Beach article. A lot of work, a lot of stuff going on in South Beach.
In the beach,
Retail, Lincoln, office around Lincoln, and now here is along Washington Avenue, which used to be a good corridor for retail. It used to be the hot spot for nightclubs, and then that migrated and dissipated all over the city. But so they're redoing Washington Boulevard. Here's Banseco USA provided $22 million construction loan to Vinvarp, a group affiliate that owns the vacant redevelopment site at 1685 Washington Ave. It used to be a bank and a parking lot. And now they're going to build, they're partnering up, they're going to build to develop the mixed use project. The proposed development has been in the works for several years. In 2018, the Miami Beach Historic Preservation Board granted final approval for an 8-story building with a 150-room Thompson Hotel by the Hyatt. This is over by the convention center as well, so it's kind of like shadowed,
by the Lincoln Road area as well.
But look, this goes back to my point in these historic preservation boards. It's taken them since 2018. We're in 2022 and a half. That's 4.5 years to get some. How do these guys do it? You can't model that.
No.
And
and you have to account too, think about it. When this was first introduced to the historical board, the developer had their budget. How much had the inflation and costs and construction?
It says they paid $19.2 million in 2017 for the site.
Wow.
Previously housed a bank building in a parking lot. The developer tore down in 2019. The city of Miami Beach approved a construction notice of commencement in November, records show. This will be designed by a French architect, Rudy Ricciotti. The project would also feature 116-space parking garage, ground floor retail spaces, and a rooftop restaurant, and a pool and a deck overlooking the soundscape park. So I don't know if you remember, this is where a bank used to be, 16th in Washington. This is a nice site, and actually the bank, I believe the development, the way it is the bank went somewhere else, right? It actually went to Alton. a property that we appraised. It went over to Alton for now. And then I believe that the developer has what they're building will also, the bank will lease space there as well. And it's a real nice space. 19.2 million in 2017. But man, that's crazy. 4.5 years.
4.5 years
to develop. And this is another great development happening in Miami Beach. So I don't want to take too much time on that. But what I do want to take time on is I've gone ahead and did a little research on, I wanted to see where, how the economy is now. And people ask, and, us as appraisers, and how do we look at the market? And we're not economists, but how do economists look at the market? And the ways they look at it is they look at home sales, they look at home sale indexes, they look at home prices, mortgage applications, meaning people that are signing up for mortgages, housing starts and permits from the construction side of it. Are we building more? Are people demanding more houses, new housing? Because they said that, in the housing market, there's a shortage of inventory. And then the unemployment insurance weekly claims. So that's to see like what's going on in the labor force. Are we laying off people because the stock market crashed?
Right.
And what happens when the stock market crash is when they start looking at their balance sheets. The first thing they do is start laying off people, trying to recoup
some of try to get that bump up in the stock price.
Yeah. So I'm going to go through a couple little indexes. And the first one is the S&P CoreLogic Case Chiller Index reports annual home price gain. Right. So this is how much are home prices? Are they going up? They're going down right now, everyone, with the inventories low. So this just came out May 31st, 2022. This is the S&P Dow Jones Index released, the latest results. And it goes on and it says that month over month, so over last month, house prices have actually increased 2.6% month over month, which while it's a 10 city and a 27 composite posted increases of 2.8 and 3.1. So it's bracketed, right? 2.8 being 2.6 being the lowest, but that's the average overall. And then when you look at certain metros, 10 cities and 12 cities, which Miami is one of those, we go up to 2.8 and 3.1 increase month over month. The increase year over year now, after seasonal index posted month over month increase. So it says, those of you who have been anticipating a deceleration in the growth rate of the U.S. home prices will have to wait at least a month longer. The National Composite Index recorded a gain of 20.6% for the last 12 months. So home prices have increased 20%, 20.6%. You felt that on yours after now waiting for getting an appraisal on yours.
Yeah, and it's funny because I grew, back in the day, I was a residential appraiser. And I say back in the day, I'm talking about late 90s, early 2000s. And when we would see an annual increase of 5 to 10%, it was like, whoa, that's pretty good. And now we're talking 20.6% appreciation. I haven't seen a number that high probably since the 08, prior to 08, when it was crazy, when the market was going nuts.
Well, it was definitely a good time in the last 12 to 18 months to own a house or an asset or something, because that appreciation is through the roof. So that was the home sales, home prices.
Right.
So then you got a next index, and this is done by the trade. It's called Trading Economics. It's the index is the United States MBA mortgage applications. This is so how many people are out there actually looking for a mortgage, right? So let me scroll down here. Let's see some numbers. And it's crazy. But it says mortgage applications in the U.S. fell 2.3% in the week ended May 27th to the lowest level since December of 2018. This is a third consecutive decrease, pointing to further cooling in a housing market amid high prices and rising borrowing costs.
Right. I get my question in that when you say that number had decreased. Remember, did it break it down on new applications versus refis?
Yes. I'm glad you asked. So applications to refinance a home dropped 5.4%. So actually, refis have dropped double, 2x compared to new applications.
Of
New
course.
application 2.3 because no one wants to refi.
No, who
Add
wants to refi now with a
5.6.
5.6,
Yeah.
especially, look, I have a 2.8. Why would I want to refi to a 5.6 unless I'm up to
rubbing
my
in.
neck?
I have a 5.5.
Well, the point I'm making is,
But I got that appreciation, baby.
The past 2-3 years with the low interest rates. I mean, if you're going to refi, you're probably, if you're refi now, you're late in the game. Unless, those of the refi right now are probably.
Nobody's refining right now.
Yeah. They're the number, 5% decrease.
Why would you refi right now? Let's try to think of an idea.
If you have an adjustable rate mortgage, that will make sense why you would refi.
Adjustable rate mortgage?
Yeah, that you maybe got a year ago, and I don't know. I'm speaking out of my ass. I really have no freaking clue.
Yeah, we'll edit that out. Don't worry. Okay. So then the next index I look at, because, this is what us smart, intelligent people in the market, we follow this stuff and we track it. We make no, we don't. So this is what
I was about to say. Yeah, you can edit that out too.
This is a new thing. So, okay. So now we look at construction starts.
Right.
All right. So this is found in the census.gov. And it says monthly new residential construction starts. And this is data back to April. So they're not, it's, building permits, housing starts, housing completions. So says this is the building permits. Privately owned housing units authorized by building permits in April were at a seasonally adjusted annual rate of 1.8. Let me just get to what the change was, or the delta. This is a 3.2% below the revised March rate. So building permits are 3.2% below the following month. That's building permits. I'm a construction guy. I'm going to build a new house. I'm going to put the permit in, right? I'm putting in a permit right now for our roof. That's down 3.3%. Housing starts, privately owned, we're down. This is 0.2% down below the revised March. 0.2. No, that's not a big indicator there, but and it does say, so then you have housing completions, privately owned housing completions in April were seasonally adjusted marginal rates. This is 5.1% below the revised March. So 5.1% housing. So we got less housing being completed. We got less housing permits being applied for or pulled. And we got less housing starts. So we got less housing. So if we already have a weak supply of inventory, I don't see it getting better. Right?
No.
Now you still got these brokers out there saying that they're going to get more money for your house. So sale prices are still going up. But,
it's going to get to a point where it's going to stabilize. This is an indicator that things are slowly starting to stabilize. And it has to. It's not that it has to. When you go from, what was it a year ago, to
what?
The interest rate?
No, it's not a year ago. 6 months ago.
6 months ago.
January. It was basically like 2.4.
2.4.
And now it's at like, well, I can tell you exactly. I looked it up today and we were at 5.35. It says for today, Wednesday, June 1st, 2022, the average 30-year fixed mortgage rate is 5.35, up 7 basis points since the same time last week, 7 days ago. If you're looking to refinance your current mortgage, the average rate for a 30-year fixed refinance is 5.33, an increase of 9 basis points over the last week. Meanwhile, the national average 15-year fixed refinance rate is 4.61, up 2 basis points. Not much of a difference on that 15-year.
From
so it's a double.
It's a double because think about
6 months.
It doubled. So
not even. We're just getting to June. We're June 1st today, so it's just 6 months. Yeah.
So if you're looking right now to buy a house, you probably 6 months ago could have qualified for, I'm going to throw a number out there, a $500,000 loan.
You've said this before.
Yeah.
I don't have my
6 months ago.
Oh,
today you can't because of this interest rate.
Well, you can. You have to pay down.
You have to pay down more.
You have to put down
more money out of pocket.
Yeah.
So if you're a first-time home buyer with that, the same
Well, you're not getting
exact
in with
parameters.
5%. You might not be getting in with 20%. You might have to put 30, 40% down.
Correct.
So you got more equity in your house sitting
Correct.
there locked up. So you're less liquid.
So what's going to happen is it's going to create less demand, less buyers. The buying pool is shrinking. People who maybe 6 months ago could afford a particular house at a certain price point, because of the rising interest rates, cannot qualify.
Well, I'll tell you what else is not shrinking, but increasing. So here's the news release of the unemployment insurance weekly claims, which is up 7,250 claims. That's the 4-week moving average. 4 weeks, if you don't know, that's 1 month. So it's up 7,250 claims across the United States. That's not completely focused on Florida or granular down here in South Florida, but it's scattered across the nation. And that means that people are out there, some people getting laid off and going in so if more
getting more layoffs, you're getting more layoffs, higher interest rate.
Well, here's the I'm showing the 10-year US 10-year Treasury note right now on the Wall Street Journal markets. It's at 2.914. And that is, let me see what it is. This morning it was at 2.8, so that's and 2.86 yesterday. It was at 2.914. It's still under that 3%. I don't know. That's so what did I just show you? I showed you that unemployment claims are going up. Sale prices are still going up. Less permits, construction starts, and what was the other one? I don't know.
Less permits,
sale prices,
and I believe we had a discussion maybe in the last podcast about where the sellers are, right? Where they've gone.
Yeah. Oh, mortgage applications.
Yeah, mortgage application.
Less
mortgage application. But then also we discussed recently where.
So wait. So let me ask you, since you're managing director of Collier's Valuation and you deal with securing work for the appraisers on staff, how is bidding activity gone? What have you seen? Let's say May, the last 30 days. Since everything we're talking about is 4 weeks.
Everything
average.
ties in. Here's what I'm seeing here is probably in the month of May, we saw a little bit of uptick in work. Reason being, I had to lower a little bit of our fees slightly, right? That compiled with adding an additional appraiser to our team had given me the flexibility to be able to shorten our turnaround time to 3 weeks, right? But even with the 3-week turnaround time, I was finding myself, losing bids on jobs that I would easily have won back in February, May. Okay.
What do you mean losing bids on jobs that you would have?
Meaning what's happening out there is bid activity has slowed down slightly a little bit, which has created more. If it slowed down for me, probably slowed down for our competitors, right? What do our competitors do? They lower their fees to try to win the job. I have to take a step back and also lower our fees a little bit. And what I mean by lowering our fees, I mean like a 5, maybe 10% decrease in our fees, something that I probably would have won maybe 3 or 4 months ago easily without even thinking about it on a 3-week bid. I'm losing today based on the fees that I bid out in February, March, right? I had to lower our fees slightly, decrease them a little bit to get more competitive, because what's happening is we're starting to see a little bit of a decrease in bidding activity. And that's a sign that our work is starting to, and I hate to say the word slowing down, because it's not really slowing down per se. What's happening is we've gone from going, what was the word? Because they even used it in this networking event today. It was, we're used to being on a rocket ship, right? When we really should be more in a car pace, like steady, where we're no longer doing this crazy, put whatever number you want out there, put whatever. If you put a shorter turn time, odds are you're going to win it. We're not seeing that anymore, unless it's a 1 week turn, which we're not seeing.
I don't know. I think I took on a couple of 2 week turns that
2 week
we
turns,
got good fees on that, so we could.
Yeah,
because of that.
Right. But I think right now, even on the 2 or 3 week turn, more in the 3 week turn, and I'm starting to see we're losing jobs that I think maybe 2 or 3 months ago we should have won. And that's a sign for me that things are starting to stabilize per se. Where I'm probably going back to bidding kind of, I'm not going to say, I would probably say pre-pandemic, where, where the pricing kind of more in the pre-pandemic phase. But it's interesting to see that, because I noticed it, because, when I noticed it, the jobs, I can pull it up and you'll see it. The jobs we won in the month of April were it was in the high 20s. But then all of a sudden I took a step back and I said, let me get more aggressive on the bidding. And it almost doubled the month of May. Right. And all I did was and I didn't go crazy here. We're talking, $500. We're not talking like some crazy number here. Just reducing our bidding by $500. And all of a sudden our work volume went almost the awards, because I can just show it, just pulling up a chart, April to May. It went from like high 20s to low to mid 40s, the number of jobs we were awarded. And a lot of stuff plays into it. Portfolios play into it. Getting more bidding activity from other regions coming into our area. But I did notice that played a factor. The minute I lowered just tweaked it, just a minor tweak, boom. And
I think after going to that, not to cut you off, but excuse me, after listening to the lenders and the brokers on the finance side today during the conference, there's a pause.
There is.
So and like they pointed to as like they want a soft landing. So there's going to be people that are leaving the game, and there's going to be lenders out there that are staying into it and adjusting their LTV, adjusting the debt coverage ratio,
Mm-hmm.
and allowing for that negative leverage to, like you pointed to earlier, with more looking at where's the debt yield at the 3, 5, 10-year point in the holding period. And I think that, here is one thing that I just rang a bell, that I liked what Chris said. He was positive about construction.
Yeah.
He mentioned the industrial that's been going on in Orlando. He mentioned that the lenders that have been lending on that Class A industrial in Orlando, their balance sheets are pretty much full on that.
Mm-hmm.
But the appetite, he thinks, that Florida demands and provides for potential developers in construction and clients and potential vendors to come here, piggybanked on the population increase for South Florida, and with the whole bringing other companies here, that construction will continue
For the Class A product,
and people will continue to lend on construction, which is that's
and it's even often because
we do a lot of construction,
do a lot
of built up, we do a lot of developments.
And you look at the majority of development we've been working on have been multifamily and office lately.
Yeah,
the majority had been we've done a ton of multifamily work, especially on the ground up side. And
that makes sense too, because like the industrial is in Orlando.
Yeah.
And that's Ryan Williams.
Yeah. Yeah. And it's interesting to hear that there's such a demand for industrial in that corridor, to the point that banks and lenders are no longer lending on them, because they're concerned about having too much of that product type on their balance sheet. But then where do they go? Do they have to go the hard money route? you know, I
Where's
don't know.
Who goes?
The developers, when they're coming to the banks or
Well,
they're
they're just
coming to the
gonna move to a
investors and
different region.
they're saying
They're gonna move to a different
they
region.
have to maybe move to a different region. But when you look down here in South Florida, look, the majority of the multifamily work we're working on had been ground up. And then primarily, especially I've seen it a lot in the Little Havana area where they're coming in and they're gutting these older buildings, they're repositioning them as a nicer product, you know, to take advantage of the rent increases. But yeah, it's you know, it's interesting to see now how, you know, we talked about in this conference how they had to change the way of thinking and get a little bit creative, right? You know, even us, we have to go back and take a look and be like, all right, you know, there's a lot of competitors out there on the appraisal side, right? If we slow down, they slow down.
Well, on that point, and with the development, brings me into this other article that just came out, and I saw it pushed all around on social media today. Show a little picture. There you go. But it's talking about the pipeline in Brickell and saying with at least a dozen projects in the works, Brickell stands to gain over 6,000 apartments and condos over the next few years as developers bet on continuing demand for new housing. Show that. There's all the projects going on. And so, you know, we did our market analysis a couple months ago. 6,000 units can be absorbed, will be absorbed with the migration of people and population increase down here, with the jobs increasing down here, with, you know, the cost of living is something that we do have to watch. We have to watch the affordability for people to be able to afford these, you know, high rents per square foot and per unit, and then also for the people that are going to come in and buy these condos. But the condo buyers are a little different than the actual people that are renting, right? The condo
Correct.
buyer can be living in Venezuela, they can be living in
They
anywhere,
can live anywhere in the world and turn around and buy a unit, yeah,
and they can rent it out, and then that's, you know, competes with the rental market. But says this year alone, Michael Stern's JDS Development Group, New York-based major food group, expect to launch pre-sales of their planned 259 unit skyscraper major with condo prices between 1.6 and $11 million. Of course, 11 million is reflecting the penthouse. Also, New York City-based Property Markets Group has also proposed a pair of residential towers, 803 units. Tel Aviv-based Kazit Globe Group proposed 504 units. We've got 88 Brickell Avenue. It's 259 units. PMG at 101 Southwest 9th Street. They got 31 story tower, 46-story tower on 1.2 acres. The towers would share a 1-story lobby, 11-story garage, and pool decks on 13th and 31st floors. 31st floors, that's amazing views. 13th floor investments in Key International, 609 Brickell Ave. Yeah. Developers propose an 80-story condo tower
right there with the church is.
That might not go through because they can't. It's right down the road.
Yep.
Right. It's like what, 2 parcels over to the north of us. That's the parcel, right? That church, or is it the church?
That's the 609 Brickell. It literally right on the other side. That's the church where the food trucks are. That right, really exactly. You can't miss it. It's a hole.
They're holding back.
They're holding. It's crazy. You know.
Go ahead. Speak about it. I'm not the right person.
Well, what I find interesting here is
they pay no rent.
They're paying no taxes.
And they're holding
paying
out.
No taxes in Brickell.
What do you think they do with the money? When they get paid, what are they going to do with the money? They're going to go build a bigger church?
What they do with the money.
Retire? What happens to that priest?
The money go to the missionaries.
Does it?
I don't know, man.
I'm
trying to be PG here.
Does it go to Rome?
No, because that's not Catholic. That's not a Catholic church.
Oh, what is it?
I don't think it is. I may be wrong, but I don't think it is.
Really?
I don't think that's owned by the Archdiocese. If not, they would have sold it already.
You think?
Dude, they just sold where the old Curly High School was. I think they sold it for some crazy number.
I don't know what that is. Anyways, so yeah.
Yeah.
The church is holding out for more money.
Well, but here's it's funny because I think from the various articles I've read over the past couple of months on this location, it's been a hot topic here. I don't think it's just the church that's holding up here. I think it's a combination of a lot of the residences in that area are against it.
No, it's not.
I don't think it's just the church.
No, it's
Why
not.
would the church be against selling that property?
They want more money, man. There's no residents that are out there lobbying against another tower. It's only towers here.
Well, you got a good point.
This is a corridor of towers.
Yeah, you got a good point. You have a good point.
You
have a good point.
You know what I mean?
You have a very good point. I mean, I can't see the food truck drivers there petitioning not to,
Yeah. We need this parking lot.
I don't know. I don't know what to tell you here because I'm pretty sure if you were to go online and dig deeper into this, there's more to it than just the parish are opposing this deal. It is literally the only on this corridor. I mean, you just look at an aerial map of this corridor. It's a hole on Brickell Avenue. There's no other vacant land along Brickell Ave. If you really think about it.
Well, let me get to my next one. So Mass Capital at 1420 South Miami Ave that I appraised a couple years ago. That was owned by the Chinese, and then they had the breakup of their ownership, and now they resold it. It's for
we did an article on this.
$3 million for the site in December. It's projected to have 1,250 units. It would include an 80-story condo tower with 400 units condos and 2 multifamily buildings with 850 apartments. So I think that one does it say how big it is? Yeah.
How many condos are going to pop up in Brickell?
It doesn't matter.
I mean, no, it does matter.
It matters.
It matters because
it matters, but it's ready.
But here's what I look at. When you have these condo towers, we've talked about affordability here, right? Who are these condos buyers?
Everybody wants to say this. Who are the buyers?
Who are the buyers?
Who are the buyers?
Foreign investors.
The buyers are foreign investors. The buyers are also CEOs, executives, cryptocurrency, funds managers, financial people that are moving here now. The population, if you're bringing in a company, right, a tech company with your C-suite executives, they need somewhere to live.
Of course.
And
I don't disagree.
Those are the people.
Add up the numbers. How many condo units are going to be in the market within the next 2 to 3 years?
6,000.
6,000.
Yeah, we already did the market analysis. Me and my team. So it's going to be absorbed.
But you and your team also focus on on the rental aspect of it. You're not looking at just condo.
Yeah, we did. We did it before and they pivoted. So yes, we did.
Okay. Hey, listen, man, you've done your homework. I get it. I'm just sitting here looking at this going, holy crap. I'm 6,000 units, condo units. See, I can honestly,
because the sweet spot is between $1 million and $3 million. That's what the sweet spot is, right?
I get that. Yeah,
there's some high class penthouses up there that everyone has to build because you need that to offer it. But I mean, the sweet spot is like 1 million between 3 million, and dude, people are paying for that.
But it's funny because I look at this and I say, if you tell me 6,000 multifamily units on 6,000 rental units,
downtown Miami, man, one of the best cities in America.
I can see that.
Why do you think we can absorb it?
You know,
we're a gateway.
Gateway. Yeah,
we're the technology hub.
Technology hub.
We're the Silicon on the East Coast.
All right, Moisha.
We are the South. Wall Street of the South.
Wall Street. Yeah. You know what? You know, you're probably a better salesman, man. Come on, man. I'm just looking at this going, as an outsider observer, I'm going 6,000 condo units. You know, it's not just the condo price. You have the fees.
What do you think your house is going to get appraised for? 800,000? Oh, you're not far from the $1 million fucking condo. Oh, sorry. You're not far from the $1 million condo.
I'm not there yet, man.
It's not far. It's $200,000 away.
Yeah.
So that's who it is. It's you. It's you buying it.
Here's me.
No, it's you buying it.
No, it's not.
Managing director of a company. You know
but it's not just me buying it. You
yes,
got to understand. No, it's not just the mortgage. What about the additional $2,000 a month you're going to have to pay on top of all that?
It's not that.
For your HOA, okay, I'm sorry, $1,100 or $1,200.
No,
How much you think it is? Oh, that's right. How much is it? Mr. Baller living on the east side of Brickell.
It's not that. I mean, of course, depending on if you live in a
What are the
one
amenities?
of these towers.
These towers are not going to have a cheap HOA fee.
That's more in like when you go to the mixed use tower that you have, retail on the bottom, hotel in the middle, and then you have condo on top,
Correct.
and you have a mixed use of apartments. Then yeah, your HOA is going to go up there. But I mean, like, it's affordable. I'm telling you.
All right, if you say so. I listen. These guys are smarter than I am. They're going to build this. They're going to build this. They're not going to invest their money without doing their homework.
Listen, the people that are still going to buy today and develop 1, 2, 3 years out, in 10 years, that condo is being rented for lease. And that owner, the mortgage is being paid by the tenant. He's not even living there. Yeah. So that's how you have to look at it. Where it's like the lenders we're talking about today. It's geography. Look at your geography. Where are you at?
Yeah. Because they brought up suburban Chicago, which is like the worst vacancy.
It's not Chicago. We don't even have crime like that. We don't have crime. We don't have killings like Chicago, right? We got gorgeous weather, 360 summer. People love it. I mean, it's only getting better here. So if it's only getting better, rents are going to increase, and affordability should get better.
I would hope so.
As these companies,
Yeah.
What do you got? You got an article over there? You got something about Mr. Harden?
Mr. Harden. No, Mr. Harden. Bill Harden. He now when I understand, the official dean of the business school, man. That's awesome.
He deserves it.
He
Bill's
deserves
a great guy.
Man. Yeah.
Even though he's from Georgia. I won't hold that against him.
What else we got, man?
I don't know. You got something.
Let me see what I got here. You know what? We've covered pretty much all the topics, man. Maybe one that stood out for me. Let me look for it here. I had it here open. I read it earlier, and here we go.
You told me about something you were reading.
Yeah.
Caught your eye.
It was about the CEO of Chase.
What is that?
Brace for an economic hurricane. Brace yourself for an economic hurricane, Jamie Dimon says. This is out of the, this is out of the CNN business. Jamie Dimon is no meteorologist, but the JP Morgan Chase CEO is predicting an economic hurricane caused by the war in Ukraine, rising inflation pressures, and interest rate hikes from the Federal Reserves. There's a lot of this is kind of nothing new. I think you and I have touched on some of this. Right now, it's kind of sunny. Things are fine. Everyone thinks the Fed can handle this, Dimon said at a Bernstein conference. That hurricane is right out there down the road coming our way. We just don't know if it's minor one or a superstorm Sandy. You better brace yourself, Dimon said, adding that JP Morgan Chase is preparing for a non-benign environment and bad outcomes. Dimon said that the economy is distorted by inflation. He's also worried that the Fed is starting to unwind its bond portfolio, a process known as quantitative tightening. At the same time, it is raising interest rates. That's something that the market is not prepared for, Dimon said, adding that people will be, quote, writing about this in history books for 50 years. What do you take on that? I mean, I think what we're looking at here, he's being overly cautious. He's being cautious. He has to be cautious. He's not going to go out there and say everything is great. But the Fed is in a bind, Dimon said. The central bank must raise rates because of the surging housing prices and other inflation pressures. He stressed that he still thinks the U.S. banking system is in great shape and can withstand these challenges. Dimon also said that JP Morgan Chase is going to do all it can to attract talent to stay on the top of the financial world. The CEO said the bank will be religious about paying well to keep its best workers. Dimon's more cautious outlook comes just a few days after he sounded a little bit more upbeat about what's next for the market and the economy. Speaking at an analyst meeting at the end of May, Dimon said there were, quote, big storm cloud on the horizon for the economy, but expressed hope that they may dissipate. If it was a hurricane, I would tell you, Dimon said at the analyst meeting, adding that current conditions also aren't like the tsunami that banks faced in 2007 and 2008 when the mortgage market was melting down and several large financial institutions collapsed. I would agree with that. I think a lot of it has to do with in today's mortgage climate, especially in the residential side, you didn't have all those crazy 120% LTVs that you had back in the day. Nowadays, you still, no matter what, even if it was 95% LTV, you still had something. And this is just from, I was an appraiser back then. I was also not just an appraiser. I was a residential investor back then. I was able to do what they call the 80-20. You get an 80% LTV on your first, get a 20% LTV on your second. No money down on your down payment, finance it all. Here you go. You're a real estate investor. That doesn't exist today. And I think that's why I have to agree with his position on this. Diamond may not predicting a tsunami just yet, but a hurricane is bad enough and certainly more damaging than a regular storm. Diamond said he is also worried about the conflict in the Ukraine and the impact it will have on oil prices, predicting on Wednesday that it is in the card for crude prices to eventually spike as high as $150 to $175 a barrel. Wars go bad, they go south. They have unintended consequences, he said, adding that the conflict will continue to roil the commodity markets around the world, impacting the price of oil, gas, and wheat. What are your thoughts on that?
My thoughts are you should listen to Jamie Dimon, but I'm no economist, so let's move on the news. I have an article that says, it's from the Business Journal, the digital age comes to commercial real estate lending.
The digital age.
Boom, boom, boom. This is kind of like, it says, so when Zakov Czar and Sammy Greenwald founded Lev, L-E-V, a technology-powered commercial real estate transaction and advisory platform. In 2019, the idea was to utilize machine learning and artificial intelligence to streamline commercial real estate transactions. What the two didn't expect was along the way, they decided to take on a direct lending for commercial real estate too. So it says commercial real estate has a reputation as a relationship-based industry. That's what the lenders were talking about today, getting on the phone, making those connections, right? The right deal requires knowing and trusting the right people. This is one of the reasons technological advances have been neglected in commercial real estate. But with transactions, banking, and lending becomes increasingly digitalized, Lucas believes relationships will not get you the best deal these days. We're just in a very different digital world of finance, he said. And listen, let me speak to this directly about when we were trying to finance the hotel. If we could have done it faster, that would have helped.
Of course.
So that's what this platform is talking about. It says it's 2022. Whatever it is you're talking about, unless you're required to go into a store to buy something, you're going to do it online. You don't even need to go to the store anymore to buy a car. You can buy cars online and get them delivered to you with a loan. Several companies are working towards bringing the digital experience to commercial real estate, specializing in specific angles in the industry. First American, for example, is developing technology to make the entire title process easier, faster, and more transparent. JLL Technologies is investing in startups using AI and data analytics to help improve specific processes in commercial real estate. Yet, when it comes to commercial real estate lending, the potential for data and AI are less discussed. By using data and AI, Lev Lending streamlines the experience of transactions. So it ends up by saying, overall, Lev is a capital markets platform that leverages data and AI to improve the experience of commercial real estate transactions for borrowers, brokers, and lenders. Lev streamlines the application process with the deal management tools. So this is not a commercial. I just kind of like this because I wanted to highlight, I like highlighting technology and what's happening out there. And it's happening around us where it's gonna infiltrate what you're doing, right?
Yeah.
You have to be aware of this. You have to be aware of blockchain, cryptocurrency. You have to be aware of being effective. Yes, you have to get out there and make personal relationships, and that's going to continue in
that's not going to change
commercial real estate. But technology is right on our heels.
The way I view technology, you're still going to need to have that person-to-person interaction, that the networking, the relationship driven, right? The way I view technology, and especially the way we are today, it should be very simple. I meet with the borrower/sponsor. I got the deal signed up. It should be a streamlined process from then on using the most modern technology.
I
Right?
agree.
With the title
sure.
process right there, that's a good point with the First American deal, down to even us as appraisers. Okay. Even now, even going back to every step of the process should be streamlined and should be using the most advanced technology. And you can probably shave a week, maybe 2 weeks in the whole process right now, because we're still, as far as I'm concerned.
Well, they're saying like the title business is the perfect business to be on blockchain.
Right. But the issue with the title business here, you're also at the mercy at the state levels and the local municipality level. So if we're lucky here in South Florida, Miami-Dade, we're a huge metro, we're a huge region where some of the local municipalities are more advanced in technology. I don't know on the state level where they are, but to me, the whole streamlined process of getting approval, getting a loan process approval. Let's start with myself as an example. On the residential front, I think a residential loan, you just went through it. You're going through it right now. A residential loan should be with the current technology and using everything streamlined. I don't see why 2, maybe 3 weeks max should be signed, sealed, delivered.
Yeah, it's definitely taking a minute.
I mean,
I have all my documents in with excellent credit and I think our LTV is 50-50.
Yeah.
And so and it's still taking a minute to be processed.
I'm in week 3. I'm trying to get a line of credit. Excellent credit. I've submitted all my document. I have the income that meets the criteria, right? And I'm going on week 3 for a line of credit. We're not even talking about a first mortgage here.
So what's the bottleneck?
The bottleneck, I really don't know. I can't answer that question because I'm at the mercy of the bank, right? The bank is going to tell me, well, you're missing the insurance document. Here's the insurance document. We're missing the appraisal. Order the appraisal. I'm willing to pay for it. I'm willing to pay for the appraisal day one. Why can't we get that process started? I'm the one willing to take the risk, right? If I'm going to put the money down to do an appraisal, why not? I really don't know what's holding the process up right now, because all I get from the bank is, you should have something next week. Go buy a house right now. It's still back. The process of buying a house has not changed since when I bought my first home.
That's why it's going to be disrupted.
Yeah, but 1998, I bought my first home.
That's why this is all going to be disrupted.
It hasn't changed.
No, but it's changing. That's why I bring up articles.
Yeah, but listen,
it is changing.
It is, but
there's people out there right now thinking of ways to disrupt the whole
industry. Of course, and it needs to happen. And it all boiled down to, I get it from a lending standpoint. There's risk involved, but if you have someone who has perfect credit, meets all the criteria, checks all the boxes from the income side, the credit to debt coverage ratio, if they check all the boxes, we're talking about the perfect client here. Why does it take the same amount of time than just but just a regular another individual who doesn't meet those criteria? Still the same process.
That's why they're saying that it should be.
I'm on board. Whatever needs to be done to
technology, so it can increase the speed of the transaction, and that's what everyone is saying. And I agree with them, and you're on the same level. But it takes programmers and people, going to school for computer science to bridge themselves into our, find these different industries that have these disruptors. Dude, it's out there.
It's out there.
That's why I like reading these articles because it's going to happen, and it's actually happening.
You know what helped? One of the panelists had a degree in computer science from Dartmouth, and he's now in the commercial industry platform. So he has he's thinking that way. I mean, obviously, you're not going to have a commercial degree from a computer science degree from Dartmouth if you're not applying
Yeah,
that.
but he did that 12, 15 years ago.
Yeah, we don't know. I don't know.
I do, because he said he's been in the he's been in the
In
industry,
the industry
forever,
for forever.
like,
Okay.
that long.
Yeah.
So yeah, he had that degree a long time ago. So I mean, maybe he's more apt on working with programmers and people in that industry, and you know, hopefully that's what my son's gonna go through.
Get in the
and
forefront
get in
of
that.
this because
But, like,
it needs to happen, man. I
no,
can't
it's
believe
happening.
but
It's
here
not, it needs to
okay,
happen.
it's happening.
It's
Fine,
happening.
but to me, it's
Like I
still
said,
mind-boggling.
listen, titles for blockchain, that's happening. Like,
Okay,
all they have to do is you take your title and then you put it on blockchain, and now that's a smart contract. So you don't need a title company to go and search the mortgages and see where the title lays, right? And it's a ledger on the blockchain. It's that fast. You're getting rid of all that gray area and all that time and the money that's in between that.
but then my response to this is it's happening, but to this day, today, we're talking about today, we can't predict the future. It's still taking the same amount of time to close a loan as it did when I bought my first property in 1998.
Yeah.
It is no different.
Yeah, but
And the same.
let me ask you something. What did you see when you walked down the sidewalk today in Brooklyn? What did you see? What passed us that's a little bit of a glimpse into the future? What was it? What was it?
A little cooler that was going with a little orange flag delivering food, and it looked to be a little robot.
No, it was
a robot.
And that
The
robot
was delivering food and stopped at an intersection.
While we walked across the street.
Yep.
Waited for it to walk across the street.
Yep.
Went across the street, rolled across the street.
Rolled across the
when
street.
it was allowed to roll across the street on its own. And where
Yeah.
it was going, I have no idea.
No, it was delivering food. We know that because
Back
it was
to
a
its
little
owner,
cooler. We
or
don't
back
know.
to its
Yeah.
employer.
Yeah.
Right?
Yeah.
If you don't think that technology is out there and working, that is the best example I can show you.
Well, look, go to Sergio's.
I don't have to go anywhere.
No.
I saw a robot
we saw it.
going down the
firsthand.
sidewalk today.
But
by
also
itself.
go to Sergio's. You know, have you ever gone to
I
Sergio's?
don't even know what Sergio's is.
Sergio's is a
Sounds like
Cuban
good
restaurant.
Italian restaurant.
No, it's a Cuban. You order your food, the robot delivers your food to your table. It comes from the kitchen, and on top of the robot is a tray full of food that brings the food from the kitchen to your table.
Yeah, I'm kind of weird with that though.
Well, it's no different than than a little robot knocking on your door and you opening the lid and grabbing the food.
My friend owns restaurants, and he has, like, you know, where the concept of you're sitting at your table and you can order your food,
correct?
Which is kind of cool.
What you do, by the way, with a regular rate twist. This is just the person bringing the food to your table.
Yeah, I know, but it's like, man, it's like, let me ask you a question. If you go to an expensive Italian restaurant or some,
I want a person.
You want a person.
I want a person.
You
I want that.
mean?
I want that. You know what it is?
Like,
it's part of the experience.
Tell me the experience. Yeah.
It's part of the
And
experience.
they're gonna be like, oh, this is so
yeah,
good.
Yeah. You got to try this. You got to try the cannoli. You got to try the wine.
About it. I'm gonna bring you this.
And I'm a wine drinker. You got to pair the wine.
Yeah.
Try the wine. Try this. Listen, I'm all for having a person.
Depending on what kind of place it is, and like, yeah, it's cool for effectiveness and speed to be able to do that with technology. But then again, I like that authenticity of a human touch and people coming and telling me about food. So it's like, I'm weird about, like, in hotels and restaurants about people being, replaced by robots. Now, delivery and shit like that, I'm fine with it.
Wow.
But, like,
well, even a hotel, people think, okay, you go to a kiosk and there you do your check-in. There's something about
that's been going on since I went. I'm a hospitality major. That's been going on they've been trying to figure that out forever.
I agree, but there's something about having a person there to interact with.
I've been that person, and I'll tell you what, that position is not fun.
I didn't say it
because if you're planning for a vacation, right, and you have a third-party travel agency online that you booked with, and something happens, like maybe you live in Kansas and you're flying to South Beach, right, with your wife and your two brats, and you get here and you just can't wait to get into there, and maybe you're gonna I can't wait to
you
get
got the
that
worst
bar.
experience
I want
in
to
the
get
airline.
that pina colada, and you can't get to your room because, sir, I'm sorry, I don't have your reservation. And you're like, what? I put down $5,000 for my whole family to be here for the next 2 days. This is a long weekend. Do you understand what I've been through? And we're just like, and you're like, I'm sorry, sir. And then you deal with those. Yeah. That's not a fun position.
What do you think? They're going to punch a kiosk like Wally World,
Man, I've seen some things. I've seen some stressed out people. So anyway, so technology's here. It's happening. We saw a robot going down the
that was cool because we were walking by. We're like, huh?
Yeah.
And we looked down and it was just a little, all you see the little orange flag. That's what caught my attention. The little orange flag.
So if your city doesn't have a robot going down the sidewalk, you better get one, or you better move, or I don't know. So my last article is here. This is going back to how Miami is expanding, how people are moving here, how developers aren't afraid to develop, how lenders are looking at developers to lend to, and thinking that is what's going to bring them, through this whole, I guess, what is it called, adjustment in the market right now. So in Miami Midtown, there was a purchase of, I think it was like 1.1 acre, a little over 1 acre. 1775 Biscayne Boulevard sold for $49 million. That is, at a per square foot, is $1,000 per square foot.
That's
if you're
insane.
looking at land in Fort Pierce, where I bought my townhouse, on the beachfront, it's $15 a square foot. This is in Midtown Miami, right? On Biscayne Boulevard, which is US 1, which is a prime corridor for retail. This is a block, full block, right? For this project. It sold for $49 million. It last sold for this says the Webster Bank provided a $33.44 million mortgage. So even though it was land, they still got a mortgage on it. It wasn't a cash buy. The property is on the east side of Publix supermarkets and just west of Upper Town. And this has been a wave of development in the part of Miami in the recent years as more people seek to live close to downtown and cultural attractions such as the Adrian Ash Center for Performing Arts and the Frost Science Museum. In 2017, V Downtown filed plans to develop. This was the prior owner to develop a 53-story condo totaling 1.2 million square feet, featuring 44 residential units and 200 hotel rooms, 45,000 square feet of commercial space, 64,000 square feet of office. You talk about a mixed-use project. But the new owner said it plans to develop the property with a 40-story tower featuring 540 apartment units, 14,000 square feet retail, and over 600 parking spaces. That is a more realistic development, in my view. You got, apartments, you got parking, and you got some retail on the ground floor. Not your office condos. Come on, that was ridiculous. Amenities will include, Class A fitness center, rooftop pool deck, co-working spaces, and aims to break ground in early 2024 and complete the project by 2026. That's a 24-month construction timeline. It says expanding our multifamily development. They're from Pennsylvania. So
interesting.
Pennsylvania developers are coming down here trying to get a piece of the pie
in South
expanding
Florida.
their business in South Florida, Southeast key component growth. Blah, 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 blah. According to the website, requires a residential commercial developer, but man, just over 10,000 apartments and 88 million square feet of commercial. So they're not new to this. And, these are professionals. They're taking down a big chunk of land in Midtown for $49 million, $1,000 a square foot.
Jesus. That's insane. That's insane.
And I'll tell you what, it's zone T636BO, which has a FAR of 22 and a buildable FAR of about $46. And on that note, I just put it on my new appraisal for Mana. So signing off, Mr. Ralph Pena. I'll see you next week.
On that note,
And
see you next week.
Talk about it then. Thanks for watching the broadcast. Subscribe. Hit that button on YouTube. Trying to get that subscribing number up. Have a nice night. Bye.
Bye.